So Bill's up first. He's a 29-year resident of Deschutes County, and Bill Kuhn is the Bend Market President of First Interstate Bank. He has a BS in Finance and Economics from Oregon State University, go Beavs, as well as a study in International Business from Linfield College. Giancarlo Gatto is our second speaker. He is also with First Interstate Bank. He's a residential lending professional at the bank who has been originating loans for over 20 years. He's worked both in the banking and private mortgage environment, so he'll bring both those perspectives. And their presentation today is residential and commercial lending. All right, and without any further delay, I'd like Bill and Giancarlo to take it away. Gentlemen?
Good morning. My presentation today is titled The New Normal in Commercial Lending, with a big question mark. I'm sure many of us have felt like this over the past many months. In times like this, it's good to keep your sense of humor. Hashtag stay flexible. The early days of the pandemic. Almost immediately, there was a widespread impact from the pandemic affecting both businesses and individuals. In the early days of the pandemic, this touched virtually everyone, from significant increases in unemployment, new protocols for running a business, and changes in everyday life. With this fear and uncertainty early on, business owners and developers needed more clarity on economic conditions, and the effects of this pandemic put many projects on hold. I will give the federal and state governments kudos for the multi-trillion-dollar stimulus funding enacted early in the downturn for businesses and individuals. Many of these included programs supported by the SBA, Paycheck Protection Program, the EIDL program, and Main Street Lending, deferred tax payments for businesses, and also direct payments to individuals, taxpayers. I believe that the CARES Act, or the Paycheck Protection Program, deserves some special mention. This legislation was approved by Congress the morning of March 27, 2020. Early on, it was determined to deputize banks and credit unions to underwrite and approve loan applications. Banks were told to be ready to start taking applications on April 3rd, while frankly, the guidance was still being developed. First Interstate Bank funded its first loan in the local area on April 11th. Of note, this program was the #1 priority for our bank from its inception through mid-year. In the Bend area alone, we funded over 800 loans, totaling in excess of $90 million in funding. What made this program unique is that nonprofits could also qualify for funding as well, and this allowed many of these vital service providers to keep their employees in place while planning for what the future might hold. Now, our institution, like many others, are heavily involved with PPP loan forgiveness to complete this process, and starting to see good volume with SBA approvals. PPP funding was a good short-term Band-Aid, but not designed to be a long-term solution. With regards to interest rates, the Fed took immediate action with its monetary policy once the enormity of the situation became apparent. Before the end of March 2020, Fed policymakers drove short-term interest rates to essentially zero to provide needed stimulus to the economy. The 10-year Treasury rate followed suit and has remained in a very narrow trading range until just recently, frankly, right at about the election. These actions by the central bank serve to keep borrowing costs extremely affordable for many businesses. The COVID-19 crisis triggered a sharp sell-off in corporate debt. At the height of the pandemic, yields in both investment grade and high-yield bonds spiked. There was a disproportionate sell-off in investment grade corporate debt. They have since settled back into a normal trading spread to adjust for risk in different asset classes. With the rapid deterioration of our economy, there have been many issues related to existing loan credit quality and also risk and uncertainty in new deals. As you can imagine, not all businesses have seen the same impact from the pandemic. Some continue to perform quite well, while others suffering from declining demand and a significant impact on revenues. The majority of the impact has been felt by hospitality, non-owner occupied commercial real estate, and also retail establishments due to government regulation and ever-evolving protocols in place. The aforementioned PPP funding helped by injecting cash, which served to supplement revenue disruption from the pandemic. Rent deferral has also been an ongoing issue as many tenants, both businesses and individuals, chose to defer or modify existing lease terms. This has had an impact on some property owners' ability to continue to service underlying debt according to terms. Many commercial clients have also elected to undergo payment modification, either going to interest-only payments or complete payment deferral for a period of time earlier this year. Creating additional challenges with loan performance has been the governor's extension of the moratorium on foreclosures through the end of the year, impacting both commercial and consumer mortgages. As can be expected, these issues have created many loan underwriting challenges as well. First, I'll mention the impact of the appraisal process. All appraisals now include a COVID disclosure, essentially notifying the reader that there is likely to be an impact from the pandemic, but in many cases, it's still too early to tell. Many appraisers have started to take the approach to lean towards a more conservative approach on capitalization rates and rental rates, essentially viewing this as a negative anticipation in the appraisal process. There's a perception of increased risk, which also may not yet be quantifiable in the appraisal process. There's also a current and future impact on various asset classes. Not all asset types have been impacted equally. In order of risk, hospitality is likely at the highest level of risk right now for obvious reasons, followed by retail, office, multifamily, and then industrial properties. Each has its unique set of challenges. Vacancy rates are starting to trend upwards, and pre-leasing activity on new deals is vitally important. We're also starting to see lease modifications as well for certain type tenants. There is some concern going forward that as leases start to mature, these tenants will decide to either downsize their space or potentially go to some other type of program going forward. There's another issue going on out there right now with regards to rapidly escalating costs of construction, which has had an impact as well with rising lumber and commodity costs, as well as limited availability due to impacts on supply chains. All these are having an impact on the financial viability of some projects. My post-election comments will be brief. With the change in administration, there will be increased scrutiny on tax policy and expectations on interest rates, both short and long term. There's also some hope that post-election, more economic relief can be enacted by Congress sometime before early January. With this uncertainty, all banks are dealing with a heightened level of regulatory scrutiny. Essentially, commercial loans are typically booked on our balance sheets, which means that we then need to follow for updated financial results and also undergo considerable effort monitoring ongoing risk assessment. Many banks have also had to adapt to a change in accounting policy, which took place January 1 of 2020. This policy is known as CECL, or Current Expected Credit Loss, which creates a further impact to loan profitability due to more granular loan loss provisions. The rate environment going forward with regards to Fed Fund futures, with a significant decline in short-term interest rates earlier this year, this has had an impact on compressing net interest margins for banks. With these issues, we must have a renewed focus on pricing to risk for each loan. In summary, with positive news of the development of a viable vaccine, it is apparent that we will be recovering, however, to a different type of economy. Irregardless, as an institution, we have kept the lending faucet on since the start of the pandemic with fairly robust loan activity for the year. We continue to focus on taking care of the financial needs of our clients and the community. Thanks.
All right, thank you for joining us in our virtual environment. I'm here to talk about residential mortgage lending and the challenges and opportunities we faced in 2020. So it's all about the rates in 2020. Most of the residential mortgage market activity this year can be traced back to one driver, the interest rates. Back in 2019, a rate in the high threes on a 30-year fixed was about as good as it got. As you can see from this chart, in the early part of the year, the 30-year fixed rate was in the mid threes, and then it moved to below 3% as the year went on. The 15-year rate moved in tandem and bottomed out in the low twos. And an interesting note is the 5-year ARM, along with most other ARM loans during this period, had little or no impact in the market as the interest rate was in line with the 30-year fixed rate for most of the time. We had refinance madness in the beginning of the year. So an almost 1% decrease from the previous lows of last year made refinances viable for people who had taken a loan even less than a year ago. And it gave even more value to those who were on the fence with rates in the low 4% range in 2019. With median home prices in the $500,000 range for much of our area, our loan amounts tend to be a little bit higher as well. And with an average savings of $200 to $300 on a $400,000 loan, closing costs were recouped on these loans in less than 2 years in most cases, which is exceptional value for a refinance. In addition, most homeowners found themselves with additional equity in their home as a result of the market growth and property value increase. And from a mortgage perspective, this resulted in an opportunity to further reduce the rate with a lower loan-to-value ratio, eliminate mortgage insurance or lower it in some cases, and the potential to consolidate higher interest rate debt or variable rate debt in the form of home equity lines of credit, et cetera. In short, it made sense in 2020 for almost every homeowner to at least explore a refinance, and for many of those homeowners to take advantage and go forward with a refinance. We had a record-breaking year. Not to overstate the obvious, but 2020 was outstanding in mortgage lending. Totals for the year are expected to surpass $4 trillion for the first time, and it wasn't just all refinances. Purchase transactions are expected to push their highest levels since 2005. 2020 also came with operational challenges and diverse needs. So looking at the numbers, it all sounds great news. Interest rates are down, loan volume is up, but as we've all experienced, this growth came with many challenges during the course of the year. The massive influx of new loans created operational challenges industry-wide. The lockdown coincided with this initial rush to refinance, and as it did for mostly all industries, it complicated staffing, put a strain on technology, and as we shifted to remote work, it created inefficiencies as workers learned to handle homeschooling, quarantine, and all the things that came with our lockdown. Some of the other additional challenges were related to third-party providers like appraisers and escrow agents who struggled to get safe access to the properties and coordinate in-person signings. Combined with record volumes led to longer turn times for most lenders, and underwriting and closing turn times increased as a result. To complicate matters further, not everyone was in a position to take advantage of low rates. In order to refinance, borrowers still had to have regular employment. A large majority of regular employees saw either interruptions to employment, reduced hours, or even job loss. These changes made it very difficult or impossible to be approved for a refinance. The only alternatives for relief came in the form of mortgage forbearance, as it was laid out in the CARES Act earlier in the year. This provided borrowers with the ability to pay their mortgage payments and delay them for 3 months without penalty. While this provided temporary relief for some, the payments were not forgiven entirely, and arrangements needed to be made with their individual servicer as to how they would be handled. The treatment was inconsistent and varied between lenders, and this created some larger issues. As forbearance period came to an end, some borrowers who took the forbearance as they were unsure how their work situation would pan out. They had difficulty refinancing or purchasing down the road, as requirements in many cases had them needing to make 3 on-time mortgage payments in order to qualify for the new loan. These borrowers have found themselves on the outside looking in many cases, hoping that rates stay the same or homes that they're interested in stay on the market while they're in this waiting period. Additionally, Fannie Mae and Freddie Mac recently added an adverse market adjustment to all refinances delivered after the 1st of December. So most of the refinance originated going forward and recent history are going to get a higher rate as a result when compared to purchase transactions. It's been tougher to lend. So for the first time in a long time, we saw an environment where it became a bit tougher to lend in certain scenarios. The industry has generally enjoyed a gradual reduction of some of the more stringent requirements in underwriting. This doesn't go crazy like it did in 2006, but this year documentation required for income and assets became stringent as job stability and market uncertainty made lenders more careful about how they looked at these areas. Many decreased the percentage of the market-based assets that they would use for reserve requirements. These are things like IRAs, 401ks. Employment verifications were moved closer to closing dates to ensure that these borrowers were still employed and at the same levels. Self-employed borrowers had more of a burden to prove that their business was still open and that their income was not significantly affected by COVID, as challenging as you can imagine. The rise of remote employment can also create challenges in the lending process. It's been an obvious driver in our local market. However, each individual situation can create challenges in the lending process. Many people are currently able to work remotely, but that doesn't always mean that their employer is on board with that being a permanent change. While this may be comfortable, and they may be comfortable that they can make this change and move seamlessly and then figure things out when lockdown ends, most lenders are going to require a letter from that employer stating that they're aware of the move and that it won't affect their income. Many people are reluctant to do this for various reasons, and if it isn't explicitly stated and explained up front in the process, it can be a surprise for all involved as the loan can no longer be able to be approved. Another market segment that was affected was the jumbo loan industry. So jumbo loans are not backed by Fannie Mae and Freddie Mac like conventional loans are. So prior to the COVID pandemic, jumbo rates were equal or below that in conventional loans with interest rates. As rates dropped on conventional loans in the early part of the year, jumbo rates stayed at their prior level or even increased. The secondary market pulled away from jumbo lending, which they traditionally look at as a riskier form of lending, and this left many banks and lenders without jumbo options. Some reduced the amount of jumbo loans they did, and some had higher rates or stopped doing refinances on jumbos as a result. This has fortunately started to level out a bit, although we've not seen rates come back completely in line, but the margins have definitely thinned for the most part. As we're all aware, and as we've seen outlined in the prior presentations, the end of the hard lockdown saw a purchase frenzy that probably has still not seen its end and won't in the coming future. Adding to the refinance volume was a new crop of purchase loans, and they have come with their own share of challenges and nuance. So what does a competitive purchase market mean for mortgage lenders? Usually a shorter window to close the loans. So the decrease of time in this purchase cycle has created even more stress on an already stressed system. Appraisal turn times have increased, and the prevalence of buyers from out of area have further cut the mortgage cycle as we need remote signings and overnighted docs. We've seen an increase in requests for appraisal contingency waivers and non-refundable earnest money deposits, which further complicate transactions and raise the stakes for all parties involved. Lenders will typically use the appraised value or the purchase price, whichever is less, to calculate required down payment for a transaction. An appraisal contingency waiver on the purchase contract doesn't mean that the appraisal is no longer a factor. It just means that the borrower will need to borrow more or make up the difference with cash to complete the transaction. This can obviously complicate things for the buyer and create significant changes to their financial understanding of the cash to close and their final loan payment. One of the biggest trends I've seen locally is the increased interest in lot or land loans and construction lending. So the obvious reason is lack of inventory. If a buyer can't find a home they like in the price range that they're looking for, they start to daydream about building a home of their own. And while this is a fantastic option, it's not necessarily for everyone, as people have learned. So construction lending generally requires borrowers with more liquidity so they can handle slightly larger down payments, out-of-pocket costs, and overrun costs. It also requires them to have enough income in most cases to cover their current housing expense as well as the loan that they're trying to use to build the home. So there are solutions and structures that can accommodate many potential borrowers and buyers. However, land purchases should definitely not be an impulse purchase. It's important for buyers to understand the lending process, the construction process, and to talk to the builder about total cost, including excavation, utilities, et cetera. Because the last thing we want is for a client to buy the land and then find out that they're not able to build the home that they've wanted on it. The other driver, in my opinion, of land purchases, especially here locally, is that they're kind of looked at as a foot in the door to Central Oregon. People in the big cities and our feeder markets, they're reassessing their long and their medium-term plans, and they may not be in a position right now to make the move, but in 1 to 2 years as they transition, that kind of seems realistic to many, and it lines up nicely with a comfortable land acquisition, construction planning, and the construction cycle. So looking ahead, as our other speakers will attest to, it doesn't look like the local purchase market is going to slow down. And in support of that, most industry lending analysts believe that the same will be true for mortgage interest rates. Most predictions see rates hovering right around that 3% mark on the 30-year fixed, which will keep lenders busy with refinances and help keep housing payments down on new purchases. One study from Black Knight reports that there's over 20 million homeowners that can still save 0.75% on their current mortgage rate. It also estimates that 2.5 million of those borrowers can save $500 or more per month on their mortgage payment. In terms of election and rates, pre-election predictions were mostly in line together, stating that they thought there would be a slight increase due to a Biden win and rates would stay relatively the same with current levels with a Trump win. However, so far, it seems like COVID has been the biggest driver of the market. News of positive COVID test results over the last 2 weeks twice proved to spur the 10-year Treasury higher, which resulted in higher mortgage interest rates, only slightly. The good news is that even though the 10-year Treasury is moving higher, rates have not followed at exactly the same pace. Many lenders have increased their margins to help quell an overwhelmed production staff and slow down loan volume while they catch their breath and as their pipelines thin out. Many think that lenders will reduce these margins and rates will stay the same to put volume back where they need it to be and to feed the staffing increases they've made as a result of the 2020 rush. Many also feel that there will be increased competition as more lenders aggressively enter the market for refinance business, and that this will all help to keep rates low and in that general 3% range. What did we learn this year? So one of my biggest takeaways this year is the embrace of technology. Borrowers who were typically hesitant to use online delivery or online signature services, they were forced to adapt and seem to be fine with the transition. They're booking Zoom calls, they're uploading PDFs regularly, and I see this being a lasting change. The industry in general, mortgage industry, has been slow to adapt technology over the years, but that is beginning to change as well. Appraisal waivers through automated underwriting systems are a regular occurrence on both purchase and refinance transaction. They're adding to increased productivity and shortening those loan cycles. Tools that integrate customers' banking and employment records for real-time verifications, they've been around and they've been slow to be adopted in the years past, but we see them both being embraced at a higher clip. Refinances will still continue to be strong into the coming year, as will the purchase market by all indications. It's more important than ever for buyers to be well prepared from a financing standpoint, and communication between agents, lender, and buyer are of paramount importance going forward. I'm looking forward to finishing out the year with our strong Central Oregon real estate and lending community, and looking forward to working with you all again in 2021.